Yeah,
Look at this thing.
yeah. Two up, two down.
Look at this
Hey,
thing. God,
yeah.
money.
Yeah, I wanted the crown and to be celebrated. I rented a tux and I ordered a mink. Stood in the mirror like mama, I made it. Proceeded to brushing the teeth in the sink. Caught me a grill and I'm so melanated. I polished the chain, I ain't gold in the link. And I got me a baby who gave me some babies. I'm raising a lady and building a king. Too cold, you too busy running with another man lane, I guess. Yeah, too bold. I be running on the one way, never change my set like, I don't ever use my signals, yeah. I be in the lane myself, yeah. I don't gotta change my mental, yeah. And I ain't gotta chase my wealth, and I accept my daddy got a kingdom, and everything I ever got is his. If I ever got a problem, I'ma seek him. I never doubt him, been about his biz, oh man, been at. I ain't gotta ride on the wave when the ocean is his. Close with the kid with a
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, baby? It's your partners back in the saddle again for another edition of Real Estate Friday Training Live. Man, what it do, y'all? I gotta say it because we looking oh so fresco clean. Just take the damn picture for your mama and them, y'all. Get the motivation that you need to get through the weekend because you've seen us. It's all good, baby. Cliff, man, how you doing, big time? What's going on with you, big dog? What's going on, baby?
Man, doing good, man. You already know. Came back from the vacation, man. I'm rested.
For sure.
I'm ready to go. So we're going back to it. Had a good week,
Yeah.
So man, can't complain.
Yes, sir, man. It was a busy week for your partner. I dealt with a lot of international business that I'm dealing with, man. Closing a couple of transactions, man. And also, Cliff, didn't something happen today, big dog? Something happened today. Didn't we do something today?
You talking about the closing?
Oh, we had a closing
Yeah.
today. What you say, Chuck? Man, and then we got another one next week.
Yeah, we're working on that one more. Yep. Got that next one coming too.
Yeah, and then we got another one after that one too, right? I mean, we just over here, man, closing some transactions. That's all we doing, baby. It's all good, man. It's all about getting that back. Now, I gotta ask the question. I know you were on vacation in Cozumel with the bride, right? Without the baby, without baby girl. But did we get the bag?
Oh yeah, definitely got the bag, man. That's every week.
Every week, and I got the bag too because I look better than you. It's all good, baby. So, anyways, guys, but man, let's go and jump into it, guys, real quick. Maybe we're gonna go into the current market analysis, man, because some interesting news actually happened this week. We're gonna talk about that real fast. Cliff, appraisal in the building, big dog, licensed appraisal, man. From an appraisal standpoint, man, what you seeing in the market, man? What's going down, big dog?
Man, it's same as what we've been seeing. Still slow. It had a little bit of a pickup, but
Yeah.
we're not even close to a normal market.
Mm.
No, the amount of transactions is at an all-time low in the last 30, 40 years. So transaction volume is low.
Yes,
Ain't
it is.
nobody really buying like they used to.
Yeah.
Like I said, it's like I've been saying, everybody's waiting for cuts. And we're waiting for them because the Fed said they're coming.
They did.
So
They did.
we just waiting on when so we can get back to a normal market.
Now, what is a normal market from an appraisal standpoint?
Usually it's about inventory is about 6 months in most markets.
Okay.
Then you also have a transaction volume, which I mean that can always fluctuate, but
Sure.
you always have a certain amount of transactions from a past year, 5 years, 10 years, and usually you're about 20% of those each. Right now, for example, we're in the 30 percentile. So basically we're down almost 70% in transactions. When that it should vary, but we should only be down maybe 30% tops versus
Correct.
70%. You know what I'm saying?
Correct. So what you're saying right now, from a appraisal standpoint, we're down about 70% of what you're saying?
Yeah, close to 70% in transaction volume. So basically, if we were to cut rates to, I'm throwing something out, let's say 5%, If rates were
Mhm.
5% for the average mortgage today, you could expect transaction volume to almost triple.
This is where you and I actually differ because of the fact that from a normal standpoint, when you say a normal market, when I hear normal is even from a borrower standpoint, things have not changed at all concerning their financial picture. It may have gotten better, so to speak. The variable that's different in this context or this market is the financing or the finances of the borrower have gotten worse because the cost of living has gone up, as well as the credit card debt has gone up and the savings has went down. That's the variable that's different than previous markets. Would you agree or disagree?
Yeah. Oh yeah. Yeah. Our market is more debt now than ever, and that's the
Mm-hmm.
government. That's us.
Mm-hmm.
We're operating on a debt. But now we're a debt system,
Mm-hmm.
so that's going
Okay.
to happen. Um, but what I'm going to see is you're still going to see an increase because
Yes.
what's going to end up happening is it just becomes more affordable. The house is
Yes.
more affordable.
It is.
So, the house that's 3,000 a month is now 2,500, 2,400.
Yeah.
That to you, that's 7,000 a year. That might be that credit card payment difference. And so
Sure.
I don't think we're going to see it immediately. When I say it's going to triple, I don't mean it's
Sure.
going to happen in 6 months. I mean
Sure.
we're going to get back there over maybe the next 16 months. We'll get to that mark.
I can see that. I would say more than 24-month time frame. Again, that's peanuts when it comes to months.
Right, right, right.
My biggest source of caution is the borrower's finances. I think that's going to allow for that, or it's going to push that timetable out more because I think people are assuming because rates are going to go down, that alone is going to drive the volume. The volume is going to go up to what it is right now. I just don't see it going up triple because the borrower's finances has gotten so much more worse than it was in previous markets. If that makes some sense.
Yeah, I see what you're saying. So, and let me break it down what I mean when I say that, right?
Okay.
What you're going to see is velocity of money because you have
Okay.
trapped equity. So, like most people, right? So, we have more equity trapped in real
Sure.
estate because of the past inflation than we've ever had. There's
Agree.
trillions and dollars in equity. Why? It's
Mhm.
inflation. The houses all went up. A house that was 200,000 is now 300,000. The problem
Uh-huh.
is that
Mhm.
person's actually got 100K, but
Yeah.
it's called trapped equity. I can't do nothing with it until the property sells. I can't sell that property or release that equity until that property sells. But I'm not going to sell it if I have to go get that same $200,000 debt
Sure.
at 8%, 7%.
I
The
got you.
second it becomes viable,
Uh-huh.
now it's like, wait a second, that extra 100K I got, I want to go get another house, and the interest rate is low enough to where it makes sense. That 100K capital now hits the market. It hits my savings, it hits the market, it gets spent. Now you extrapolate that and you do that times every home in America that has that extra income, and you're talking about hundreds of billions of dollars hitting the market that's not currently out right now.
From a theory standpoint, I see what you're saying.
Right.
But here's the problem. There's a calculation when it comes to loans. Someone are qualifying for a loan. It's called DTI, or debt to income ratio.
Hmm.
The debt to income ratio for borrowers right now are at an all-time high.
Right.
It's over 50 plus percent. So the problem I have is for your reality to actually happen, banks are going to have to rework their credential qualifications to allow a higher LTV or higher that DTI ratio. If that happens, that may put loans at risk because you are approving borrowers that may not have the capacity to pay again. Now we're back in the same boat as 2008.
A
Make
little bit
sense?
different. Yeah, yeah. I hear what you're saying, right?
Yeah, yeah.
You're saying the borrow, man. True. You saying so, ain't something basic, right? You ain't
For
got money.
sure.
How can you
Yeah, I
pay for
got
it,
you.
right?
Got you. That makes sense. That makes sense.
And I see what you're saying, but what I'm thinking
Mhm.
too is incomes are going to increase because
Okay.
the velocity of money is going to increase. So when I say
Okay.
billions of dollars, hundreds of billions are going to enter the market. What comes of that? Transaction volume increases. That
Okay.
additional money being released of equity is going to go back to who? insurance company, realtor companies, construction companies
Yeah.
who are
Yeah.
right now sidelined. If you go look at some
Yeah.
of the construction companies on the S&P, you go look at some of
Yeah.
them, they're at all-time lows in the stock market. It's crashed, which
I'm
means that
rocking with you.
when we get a normal market, those values are going to go up. That's the equity hitting the market again. So all I'm saying is pretty much basic. If there's $1 trillion in the market, only $1 trillion can get spent. If
I
2
agree.
trillion hits the market, it has to force things up. We're
I
already in
got you.
high inflation right now, so
Yeah. Yeah.
you're gonna see that inflation also go to wages.
I agree with that. Here's my
Yeah.
again. Here is what I'm seeing that's been overlooked. Most people, when it comes to real estate, or when it comes to commentators that are actually on TV, they focus so much on the mortgage rate. Although that is a important a calculation when it comes to see what's going on with the market. What people are not seeing is this here is can't that there has to be an origination of a loan driven by a borrower to bring in new debt into the market so they can tap into that said equity. My caution is this here is in the past the DTI was lower, so therefore it was made it easy for the borrower to qualify for said loan. In this present context market, the DTI of the borrower is at an all-time high. So the only way that's going to be able to, for the money to be introduced back into the market is if the lender begins to massage their credentials for approving borrowers. If that happens, that could cause a catastrophic shockwave, not in a good way, in a bad way, because you are theoretically approving borrowers that may not have the ability to pay that new debt.
But hey, see, this is good. Why you need to be able to bounce ideas off, because what we're
For
looking
sure.
at is two different ideas.
For sure.
And this is good. Dale sees the
It
market
is.
going down. I see the market going up. This
Mhm.
is good because maybe I'm missing some negative things that Dale's saying, and maybe Dale's
Likewise
missing
me.
some positive things that
Exactly.
I'm saying. So,
Exactly.
and I hear what he's saying, because to me, what I see is with what he's talking about is debt to income,
Mhm.
and one of those has to adjust.
They do.
And my thought process is the only way you can adjust the debt is
Mhm.
to first adjust the income. Income becomes income solves problems, debt doesn't.
You're,
Meaning
you're talking about
it
cash
oh,
flow. I got you.
exactly. I need to have more income than debt in order to remove the debt. So my point is to say the debt to income will adjust
Mm.
because the
Mm.
income will increase, because the transactions will increase, because
Yeah.
business will increase.
So it sounds like what you're saying is this here is the only way that's going to happen is if those banks begin to massage their qualifications for approving borrowers. Uh-oh.
A little bit, man. I think overall more people are going to make more money going forward than they are now. The only reason why they're in
Sure.
the debt situation they are now is because
I
inflation.
got you.
Right.
Well, we're going to see
Yeah,
now,
yeah, yeah.
guys. We're going to see now, guys. That's the current market analysis, guys. We gave y'all a little of an MBA class in real estate development and finance right there. Go ahead and clip this if you want to. No problem. We'll share it if you want to. Now, there's some news that came out. Whenever this man talks, the market moves, right?
Oh yeah.
The Fed chairman Powell, Fed Chair Powell, was in front of the Senate this week. Okay. And he said there's more bank failures coming. And I just said, I'm not surprised by it. But this is what he said. He's in front of the Senate Finance Committee. Let's see what he says, and then me and Cliff will actually respond. Here we go.
Chairman Powell, great to see you again. Thank you for all of your good work. I want to talk a little bit about the commercial real estate and what's happening there. The Financial Stability Oversight Council's 2023 annual report identified commercial real estate as a financial risk.
Yeah.
And the Fed's monetary report also noted commercial real estate prices continue to decline, especially in the office, retail, and multifamily sectors.
Okay.
I'm especially concerned that because of the low levels of transactions in the office sector, prices have not yet fully reflected the true decline in the value. So can you expand on the emerging risks the Federal Reserve has identified in the commercial real estate market, one? And then I'm curious, can you discuss the compound risks identified in commercial real estate lending, particularly at banks with large CRE concentrations
we
and
go.
high fractions of uninsured deposits?
Okay.
Sure. Let me see. I think there are just very, very few transactions in commercial real estate right now, particularly in the troubled areas. So it's not a question of prices still falling. It's a question that you don't have that kind of price discovery. You just have to assume that the prices are very low and have come down a lot. So on commercial real estate, we have a secular change in people working from home. This is one big part of it. That means that in many cities, the downtown office district is very underpopulated. There are empty buildings in many major and minor cities. It also means that all the retail that was there to service the thousands and thousands of people who work in those buildings, they're under pressure too. And banks will have made loans to many of those buildings. Not all of them, but many. So this we've known for some years. And so what do? We have identified the banks that have high commercial real estate concentrations, particularly office and retail, and other ones that have been affected a lot. We identify them, and we are in dialogue with them around, do you have your arms around this problem? Do you have enough capital? Do you have enough liquidity? Do you have a plan? You're going to take losses here. Are you being truthful with yourself and with your owners? And so we've been working with them, and so for some time we've been doing that. And this is a problem that we'll be working on for years more, I'm sure. There will be bank failures, but this is not the big banks. If you look at the very big banks, it's not a first-order issue for any of the very large banks. It's more, smaller and medium-sized banks that have these issues. We're working with them. We're getting through it.
Now, Cliff, didn't you and I, in a past Real Estate Live, talk about how this commercial real estate bubble, and notice you talk about commercial, right? Because commercial is a big paper industry when it comes to banking. You and I spoke about on a past Real Estate Live that this commercial bubble was not going to affect the big boys. It's going to be the regional and small banks. Am I right?
Right. Yep.
So you hear the Fed chairman talk about this exact same reality, and notice the questions. He's saying that, okay, some of these loans are not performing. What plans do you have in place? You have enough capital. Remember, we talked about the debt, the discount window that the Fed is forcing banks to go to, and the discount window is a window that banks go to. They don't have enough liquidity at their banks. Now, what the Fed has done is they have forced every bank, regional, small, or big boy, to go to the discount window and force them to get capital even when they don't need it. So notice what he's talking about there. He's going to these banks, which I think is a wise move. Saying, do you have enough capital? We know these loans are not going to perform, right? So you see that dialogue. Do you see the same thing or no?
Yeah. Same thing.
Same thing. So what are your thought processes on the questions he's asking these banks, Cliff, concerning the viability of these banks, because they're really exposed because of the commercial market?
Yeah. I mean, to me, it exposes how the whole system's artificial. Like, the only reason why the banks are in the first place is because the Fed lied to them. The Fed said there's no inflation. It's a myth. It's transitory.
They did.
So the bank said, you ain't got to say nothing else. We're going to buy treasuries. So they bought the treasuries because they said there's no inflation. They were wrong. They had to raise interest rates. And now the treasuries the banks bought, and the real estate they lent against those treasuries,
correct,
went belly up because now those treasuries are worth less because the interest rates are higher.
Correct.
And now the Fed's having to go back to those banks going, my bad. I know I said to buy the treasuries, and then we turn around to raise interest rates. This is what we're going to do for you. We're going to give you access to more capital.
That window
to help you sustain the problem that we have, which tells me this, Dale, that they have to do something to resolve that issue, which is lowering interest rates and spurring the economy. They have to print more money, but they have to do it in a way that's not going to cause too much inflation, but some inflation.
Yes, sir, Doc. That's what it is. Let's keep listening, guys. He's almost done, y'all. So this is what we do for a living. We just this ain't theory for us. We it's what we do. Let's keep listening to what the Fed chairman said. So let's go.
I think it's manageable is the word I would use, but it's it's a very active thing for us and the other regulators, and it will be for some time.
Thank you. Do you have concerns? Let me just ask you this. As you're talking with these small and medium-sized banks, because we know that there's always could be a contagion, which we've seen in the past, do you have concerns that if they fail, that somehow this is going to impact the financial sector? And are you prepared and trying to address that and prevent that from happening?
We're trying to stay ahead of that. So we also reached out to banks that had high concentrations of uninsured deposits, and particularly uninsured deposits, and a lot of commercial real estate in the office sector. So we're well aware of that issue, and we're just trying to stay ahead of it on a bank by bank basis and overall.
Okay.
And so far, we've been able to do that.
Thank you. Let me jump to another issue that has been on my radar. The Federal Housing Finance Agency's report on the federal home loan banks concluded that the distinction between the FHL bank's role and that of the Federal Reserve discount window as lender of last resort is not been clear, especially during times of market stress. During the 2023 banking turmoil, we saw banks rely on advances from the federal home loan banks and didn't even have relationships with the Federal Reserve to use its discount window.
Yes, there you
I know
go.
you've talked a little bit about this with Senator Warner, but how is the Federal Reserve working with the federal home loan banks to ensure that banks establish protocols to borrow from the Fed's discount window prior to times of stress?
We work with the federal home loan banks because in many cases, banks were moving their loan from the federal home loan banks to the Fed. So we need to have smooth transfer. We need to be in good touch with them. Even more important than that, though, is that banks, any bank in the United States, needs to be in touch with the discount window, know how to be able to access it, be able to access it, have appropriate collateral, have control of that collateral. In many cases, it was incredibly inefficient and took a long time for banks to actually go through that function. The federal home loan banks are actually ahead of us in technology. We know that we need to really invest in technology to modernize the discount window, and also we need to do more to make to get our banks, all of them, in touch with the discount window in a way that they can use it quickly should they need to do so.
Thank you.
So, great exchange between the senator and Fed Chair Powell. You keep hearing the word discount window, discount window, discount window. Remember, guys, they are forcing the banks to have to go to the discount window. The discount window was a mechanism that the Fed put in place. It was kind of like the walk of shame for banks. If you had to go to the discount window, banks were like, wait a minute, 1, 2, 3, 4 banks said bank name. They're actually they're low in liquidity, so they're not doing very well. It was kind of like a back signal to other banks that said bank is not doing well. Well, now what the federal government has done, the Federal Reserve has done, is they're forcing all banks to go to discount window. That's why you keep hearing him saying discount window, because as Cliff was saying, they have to continue to print the money, which I agree, Cliff, was forced them to have to lower those rates. You agree or disagree, Cliff?
Yeah, 100% agree. So, I mean, it's wild. This has never been done before. So, you just got to understand the situation. Man, the opportunity that they're presenting is you already know what they're going to do. That's rare. You know what the Fed's going to do. They are telling you.
Yes. They are telling you what they're going to do, guys. And here's my thing. I hear all the spinning saying that we have a healthy economy. If your economy was healthy, why would you have to force banks to have to get liquidity? And it's because the banks lied to you. I'm sorry, the Fed lied to you and told you that it was transitory. If you didn't have to lie to convince the patrons that we have a healthy economy. Tell them the truth. Now you're in a deeper hole now. Am I right, Cliff? Or am I wrong?
Oh no, you're right. I mean, the economy is. Here's the problem that I'm seeing. Right, the way that people are viewing the economy is, to me, is you're saying that unemployment is low. You're saying that
Yep.
businesses are still thriving. That is
Yep.
because they're living on excess cash from the inflation,
Okay.
right? So you're
Okay.
comparing today's information to 3 years ago's information. But the difference is
Correct.
there's trillions of dollars more in the economy today.
It is.
So it's going to have to be up higher,
Mm-hmm.
right?
Mm-hmm. Mm-hmm.
So the reason why we still have low unemployment, to me, and all these other things that you see is going well with the economy, is because that is, like you said, fake money.
Yes.
It's fake. We're printing it. There is a cost to that.
Correct. Correct. And at the same time, is most of those jobs, guys, a lot of those jobs were government jobs.
Yeah.
A lot of those jobs. So the government got bigger, which means the government hired more people. Most of those are government jobs or second and third jobs because the cost of living has gone up. Inflation has gone up. Inflation is, now people say, well, inflation has came down. Actually, it's not, because they changed the definition. They changed the calculation from every 2 years to every year. Come on, y'all. Come on. Look at the fruits of the economy.
So what
Go
does that
ahead.
tell? I'm letting everybody know what you're saying, basically. And this is how I interpret it.
Talk to
To
me.
me, I've been focused on more and trying to do different things of buying some more real estate, because
Yes.
when you see they say 2% or maybe even 3% inflation, it's
Correct.
really 4 and 5.
And
So if
Cliff
you,
said, let's say this here. If they
yeah,
say it's three, if the inflation is previously, it was like, for instance, it was 9%. Now it says it's 3. The 9 is still there.
oh
So
yeah,
it's
yeah, it's
9
plus,
plus 3.
right.
So it's not 3%, it's 9% plus 3. It's 12. You can't just eliminate the 9.
Man,
Come
this is
on.
big. This is the thing people don't understand about how inflation works. Is exactly like he said. You add it. So if you keep going back, let's say since 2020, and you get the 3 plus the 3 plus 9, right? You got
Yes.
15 plus you got 3.
Yes.
You're at 18% higher than it was before. So, but
Yes.
this is how you could tell. You don't even need to trust us to
No.
know that information. Look at a
Correct.
house and go, how much higher expensive is it than it was 4 years ago? And when you find it's 18%, that's what the inflation rate is. That's how me and Dale make money in equity without doing nothing, because
Then.
they inflate the economy, and
Yes.
because you own assets, you
Yeah.
get inflated one. Don't get mad at the rich for what the government is doing. The government is making.
Exactly. Exactly. Man, that's a lesson, y'all. Man, all right, y'all. Now, he said something else. Okay. When this man talks, the market shifts. So we got to listen to what he's saying. The Fed Chairman Powell said also the housing market is in a very challenging situation. Wait a minute. I thought we was in a roaring economy. Cliff, I thought. I thought. But anyways, let's see what he says. Let's see what's going on. Let's dive into it. All right, here we go. See what he says.
Monetary policy report states that while demand for housing has fallen, a strong labor market has kept prices high. That matches what I've been seeing in Georgia. Too many folks can't afford a home. According to the monetary policy report, mortgage rates were averaging around 7% last month. That's tough for lower income home buyers. Increases of just a percentage point or two can be the difference between owning a home or not. Are you concerned about this interplay between lower demand yet stubbornly high prices and what it means for folks trying to buy a home? And what do you think is driving these high prices?
So the housing market is in a very challenging situation right now. You have this longer run housing shortage, but at the same time, you've got a bunch of things that have to do with the pandemic and the inflation and our response with higher rates. So you have a shortage of homes available for sale because many people are living in homes with a very low rate mortgage that they can't afford to refinance, so they're not moving, which means the supply of regular existing homes that are for sale is historically low and very low transaction rate. That actually pushes up prices of other existing homes and also of new homes because there's just not enough supply. The builders are busy, but they're running into all kinds of supply issues still around zoning and workers and things like that. So it's quite challenging. And of course, rates are high. So people who are buying, a lot of the buyers are cash buyers, or are able to actually pay without a mortgage because mortgages are expensive. I will say the first problem, the longer run problem of supply, is a longer run problem. The other problems associated with low rate mortgages and high rates and all that, those will.
Now, Cliff, before he goes into mortgage rates, let's talk about supply. Okay, so we understand that the supply is an issue because, as he said before, the borrowers that actually have low interest rates are not going to graduate up to a higher interest rate, right? And so, what's happening is that's called that's caused a shortage when it comes to the supply. So that's why what you're saying is by them actually lowering the interest rate, you're saying the act of lowering the rate will force those buyers, so to speak, off the sidelines so that the supply can begin to subside. Is that what I'm hearing you say?
Nah, supply is low.
Okay.
So once they cut interest rates,
Yeah.
what you're hoping to happen is somewhat of a balance. This is what you hope. I'm not
There
saying
we
this
go.
was going to happen. This was what you would hope to have happen, right?
Sure.
Is a lot of people who are sitting on that pent up equity, right? They want to sell because they
Okay.
one want that money, and two
Okay.
want to move into a new spot.
Okay.
So what that's going to do is that's going to open up more inventory because there's a lot
Yeah.
of people in that position.
Okay.
But it's also going to add people who, because the interest rates are lower,
Okay.
more buyers into the market. So
Yeah.
demand is going to get driven up.
Okay.
So the
Okay.
value of the homes is actually going to go up,
Sure.
right? So it's
Mhm.
going to get driven up more. So I think
Mhm.
that the shortage is just going to continue. I don't think that's anything that we can solve without. The truth
Mhm.
is, this is what I think about the shortage issue. I think it's false. I
Okay.
think it's a lot of
Interesting.
BS.
Okay.
You want to know
Okay.
why?
Why is that?
There's a lot of houses available in Mississippi. A lot of
It
houses
sure
available in
is.
Oklahoma. A lot of houses
Ooh.
available in Tennessee. A lot of
Ooh.
houses available in New Hampshire and stuff. The reason
Yeah.
people don't when they say there's not enough houses, real estate is what? Local.
Yes, it is.
Meaning when people say there's not enough
Yeah.
real estate, what they're really saying is there's not enough real estate in the places I want.
There you go. There you go. Right there. Yes, sir. Exactly. Guys, if you're looking at me and Cliff are finding a plethora of properties in Mississippi, Arkansas, Oklahoma, some places, Louisiana. Did you guys know that Shreveport, Louisiana is the rental capital, really almost the rental capital of the world? So is Memphis, Tennessee. Memphis, Tennessee is the rental capital of the world. I believe in Shreveport, I may be wrong on the percentage. I think it's between 60, I think it's 60 to 70% of the houses in Shreveport are leased.
Yeah.
Not owned, leased.
He's right. It's crazy. If you go look up ownership, you see LLCs.
All day long. All that tells me is you had investors see from a local standpoint opportunity, and they began to go out and acquire those properties. Cliff is right. So the supply argument most likely maybe more of a lie if you look at the totality of it. When it comes to properties 500,000 and above on areas that you may like, yeah, it may be a shortage there because why? People can't afford those payments anymore. Can't afford those price points anymore. But $300,000 and above from a licensed appraiser. Cliff, has the market slowed down at the price point $300,000 and below?
No, there's still demand. There's still strong demand.
I mean, this is coming from a licensed appraiser, not theory, someone active in the market.
Yeah, because the problem is that those three houses, 300,000 and below, used to be in the metros. You used to be able to go to Atlanta and get one.
Mm-hmm.
Go to Dallas.
Mm-hmm.
Long time ago, Los Angeles.
Yeah.
Well, think about it. Those are areas a lot of people want to live.
Correct.
So those prices are going to go up because of demand. So
Correct.
those houses don't the affordable housing you want is
Yes.
not affordable because your neighbor makes more money than you do.
Mm.
And
Mm.
he's buying that house and you're not. And you are
Correct.
forced to go someplace else because the demand of your area has increased and has driven out people who can't afford to live there.
Correct.
That's all that happens. And that happens all the time. So it's not, you can't make that land more affordable. The land's worth what
Correct.
it's worth. I'm gonna praise it. I'm gonna tell you right now, the land is what it's worth.
That is correct. That's the reason why you see such a high demand in the $300,000 and below marketplace, because number one, you have a plethora of clientele. You have, of course, buyer clientele, because people can still borrow the liquid capital, right, to be able to buy those homes and still pay that higher interest rate and not break the bank. Number two, also, you have a plethora of leasees, because people are now are downgrading from those big homes down to those smaller homes where they can afford the payment. Like, we're buying properties in areas in Mississippi, guys, to where the rental rate is like 1,100, 1,150, and we talk about 422s, 322s, 322s, 1,800 square feet, 1,600 square feet, 2,000 square feet. These are nice sized homes, but because people don't like those areas, so to speak, the retail buyer, me and Cliff love those areas, because we'll come in and just acquire a whole bunch of property. Like in the cities we're acquiring so much real estate, guys. We're going to effectively them to own the cities, because people are not even going to these areas. It's the same. For instance, we're negotiating with a realtor on one of these properties, right? And that person is talking to us big time. You better close on time. This, that, and the other. Great, no problem. We've been closed on time because of the fact that of Mississippi is kind of slow when it comes to appraisals and title companies. They are slow, right? So we kind of fell prey to that system. No worries about it at all. So we got out of the contract. Well, when we came out of the contract, we said, no problem, cool. You want to go? You want to put it back on the market? You can. Guess you came knocking back on the door again about 3 days later. That same
Oh yeah.
let us know. Wait a minute. There's no buyers here. Uh-oh. Opportunity. We're going from subdivision, buying a whole bunch of properties and land to develop, because no one is there. We're doing a lot of acquisition to lease and purchase, acquisition to lease, purchase, seller finance, acquisitions to build, develop, then lease, then seller finance out. So our strategy we have a ton of extra strategies, not just one. Am I right, Cliff? Am I wrong?
Yeah, yeah. And I actually came across one property, man, and it was unique. And they're trying to solve housing problems that way. Basically taking regular plots of land where you could just build one house, and all they're doing is subdividing that land. And what
Mm-hmm.
they're doing is that
Mm-hmm.
this obviously
Mm-hmm.
the
Mm-hmm.
land is smaller, but they're
Yeah.
building up. They're building
Yeah.
two-story, very
Mm-hmm.
small shotgun houses
Mm-hmm.
on what
Mm-hmm.
would typically we just have one house.
Correct.
And
Correct.
they're not getting and because those prices are cheaper, they can sell
Yeah.
those houses. People love them because they
Yeah.
still get some land to get a house. So
Yeah.
yeah, a lot of opportunity.
And I would say, and Mitch, you're correct on Instagram. Mitch says a lack of demand, specifically in Mississippi and Louisiana, is not due to to housing increases. He's correct, but lack of economics. He's spot on. But when I hear that, that is opportunity for me. That's opportunity for me from a real estate standpoint, private equity standpoint, and also government partnership standpoint. That is opportunity for me, because if there's a lack of capital flying through there, I want to solve that problem. Because if I can solve the lack of capital flowing through said city, I can own the city, because I've solved that problem. That
Yeah.
makes some sense.
Oh yeah, it's pretty. But like, if you're able to do, let's say, two things: first, buy all the houses,
Mm-hmm.
be able to get your infrastructure in. Then you're able to
Yeah.
convince Amazon to build a
Mm.
distribution plant down there. They
Mm.
create 10,000 jobs, spur
Mm.
more money,
Mm-hmm.
demand goes up. Housing,
Mm-hmm.
it's just a cycle. This is this real estate cycle. Real estate is driven by two things mainly: jobs and population.
It is, and
That's about it.
here's a profit equity play. Yes, you can try to convince Amazon to do that, but Amazon may say, I don't want to do that at all. No worries. All you typically do is, as a private equity investor, I'm looking for innovative technology for me to invest in that can, of course, drive sales, but to solve a problem in the marketplace. Now, watch this now. I can then place the home office in said town, right? My capital can bring in jobs coming in. I can also begin to invest my capital in the local banking systems. Does that make some sense now? Local banking areas. What? Because so now I can get capital for cheap. Now the banks love me and the city loves me now. And now I can begin to build out even more. So not only do I own the real estate, not only do I own the land, I have strategic partnerships with the banking economics there and also the city as well. They love your partner. They love your partner because I'm spurring change now.
Yeah,
Think generationally.
it's just economics. I mean, you're basically just buying at a cost basis,
Correct.
that's the way I see it. I see it as a cost basis with cash flow, and as long as you have cash flow and you think long term, you
Correct.
know, um, you'll let it kind of go however it goes. Like I say, there's two different types of markets. There's cash flow markets and appreciating markets. You need both.
Mhm. Correct. That's the reason why, guys, I say this here. Rental property investing is going to be a big play because Grant Cardone said this here, and I agree with him. He said that America is going to become more of a rental nation. Right now, it's about 60-40, 70-30 when it comes to home ownership, 70, rental 30. That's going to flip to a 60-40, 60% renting, 40% home ownership. That 60% that's actually
No,
renting is owned by somebody else, some LLC. Why not yours? Why not your fund? Why not you? And that's when rental properties come into play. Now he invests more so in apartment complexes, so do me and Cliff. But at the exact same time, there's only so much apartment units on the planet. So when those are full, guess what happens? Guess what happens next? People actually want homes, and a lot of leasees want homes instead of apartment complexes. Would you agree or disagree, Cliff?
yeah, it's a different model. The apartment complex it's a great long term play. I mean,
Mhm.
it just requires more capital, and it's longer. It's a longer cycle,
It
right?
is. It
And then
is.
you're gonna have cycles that you go up and down because you have turnover and things like that.
It
In
is.
the single family space, it's way more stable.
Yeah. It is. It is. Go ahead, Cliff. Good.
Yeah, it's way more stable, but so they each have, good and bad. But I would say
Mhm.
this, the reason why I like single family is just purely because it's easier to pick up properties.
Yes.
Multifamily is a very time intensive. You may
Yes, it
only pick
is.
up one a year if you're really
Yeah.
trying to get a deep deal.
Yeah. Yeah.
Would you hear about people buying apartment complex and they buying a lot of them? A lot of them are just raising capital and then they're barely making good percentages because they're not buying
Correct.
at huge discounts.
Correct.
They're
Like
playing the
Grant.
volume game. Right.
Yeah, Grant Cardone. He buys Class A plus, Class A plus, A to A plus. For me and Cliff, that's not our motto. We're buying Class C plus, B minus,
Oh
sometimes
yeah.
even C minus.
Yeah, I prefer. I prefer B minus. I mean, those
Hmm.
are the great ones because those get appreciation. And so,
Correct.
what I like to do is the best houses by far are small towns.
Oh,
Or I'm sorry, buying B minus houses in small towns.
yes,
That to me is, and when I say small town, I mean 50,000 or a
for
hundred
sure,
thousand or more.
for sure,
So,
for sure.
but yeah, those ones are good because that has demand within the town. They're like,
Oh,
oh,
it
it's
does.
still cheap, and it's still
It
cheap.
does. It does. And I give you guys a little bit of a jewel. If you're in the Dallas Fort Worth Metroplex, the most best kept secret when it comes to real estate investing is not Dallas. Most investors are in Dallas. It's in Fort Worth.
Oh yeah.
There's very few investors in Fort Worth. I don't know why. Because you have Fort Worth, Arlington, Grand Prairie, Mansfield, Haltom City, Keller. I'm that's a six, and nobody's out there. I don't know why. Because it is ripe for investing. Am I tripping, Cliff? Justin's another area. Go ahead.
Oh yeah. I mean, the problem is DFW is growing so fast that
Yeah.
it's just hard to find. There's deal. I haven't been in. I've only bought a couple in Dallas recently.
Yeah.
Last couple of years, I sold
Yeah.
one. I kept on to one
Yeah.
because the problem is finding deep discount deals are just they're much
Correct.
more difficult because the demand is high.
They
You're
are.
really actually out here. You can buy good deals because the goal is everybody's buying on appreciation. They don't know where Dallas is going.
Yeah. They
They
are.
know if they
Yeah.
hold 5 years minimum, it's gonna go up.
And to be honest with you,
Dallas is booming.
if you're in Dallas, though, South Dallas is booming.
South, yeah. Oh yeah.
Woo, South Dallas is booming. We talking about new construction. South
Oh,
Dallas is booming.
I own rental in South Dallas, and they're doing new construction in that neighborhood.
Mm,
So it's all of it is growing. People want to move to Dallas.
they
They
do.
know about all the big improvements that we're making out there.
They do.
It's going to be a top 3 city.
It is.
Texas is going to blow up in the next 10 years. It's
It
going to
is.
blow up. It's going to be New York, Los Angeles, Houston, and Dallas.
I disagree on New York.
You think the population in New York is so high. It could get cut in half and still be a top 5 city.
Yeah. Now you're talking about just population. Or you talking about
I'm
growth?
talking about population.
Okay. I was going to say, hold on, growth. Hell no, I don't agree with that at all. New York.
No.
No. Now I would say the top 3 when it comes to growth is going to be Texas in no specific order: Texas, Florida, and I say 4, Oklahoma
Yeah,
and
Oklahoma's booming.
Tennessee. Oklahoma is booming. It is scary what's going on in Oklahoma. It is, to me, it is the unspoken giant when it comes to discussions. Oklahoma is.
Oh yeah.
It
Oh,
is.
man, that's one of my biggest mistakes. I wish I would have years ago. I was looking at Oklahoma. I wish I would have bought more. I should have bought
Yeah.
way more in Oklahoma because the values
Yes.
just went up again. Um,
Yes.
this to be honest with you, the prices have gone up so much. There's only a couple of areas that you can go into that are big name city that
For
still
sure.
can buy at these prices or even buy a discount. I mean, it's
Correct.
harder to buy discount properties in the last
It is.
3 to 5 years than it
It
was
is.
way before then. I remember buying rental properties back in the day, cheap in Dallas. My first rental property I bought for like 58,000.
Yes, sir. That's my first one I bought for what? 60?
You know what I'm saying?
60,000? Yeah, I'm 60, man. I made 10 grand on that day. I was like, yeah, let's get it in, baby. Now I'd say this here: if you want to, guys, and we have it on Instagram as well. Mitch actually had a point which I agree with. It says Baltimore is a good C and D market. I'm gonna say this, guys, and if you guys listen to nothing that we say, listen to this. If you really begin to really spur change and get properties at deep discounts, Baltimore, Detroit, Memphis, Tennessee. I'm just gonna mention 3 cities: Baltimore, Detroit, and Memphis, Tennessee. Don't sleep on those towns. No one is going there. That's where you flock to. Stop going to places to where everybody their mama's in. That's why it's high. That's why you can't find no good deals, because everybody their mama is there. Go to places to where this is only if you have a good team around you and you are a seasoned investor. Don't go in there if you're a novice. Please don't do that. If you're a seasoned investor, you can partner with somebody that is. I go do it. Go ahead, Cliff.
Yeah, I mean, he's right. I mean, you got to understand what you're trying to do. That's why it's
Yeah.
smart to understand coming into it. That's why after COVID, I slowed down. I bought properties before then. I had slowed down. I'm coming back in, and Detroit's an area I'm going. I'm marketing to right now, and I had done it previously. I'm going back into it, and really just because the reason why you're trying to do that is. And to be honest with you, we're gonna give you some game right now. We should be doing some coaching and teaching y'all a little bit more. But
For sure.
is if you're going to climb the ladder, the easiest place to reach is the first rung. Take the first rung and climb that up. You can do the higher end stuff once you've done the past rungs you've climbed up. You see what I'm saying? So you're stair step, right? You're taking those steps one at a time. And when you have a place like Detroit, that's an easy stair step. That's an easy basic.
Easy work.
And when you get 5 or 10 of them, then doing the next ones is that much easier.
Guys, you can buy property in Detroit, some areas for anywhere from 5 to 10 grand. 322s. 322s. Yes. Now I gotta ask you this question, Cliff, because you're from New Orleans and so is Mitch. He actually made a point on
Yeah.
Instagram. He said that New Orleans, when it comes to a good place to invest in, when it comes to buying B minus properties and below. If I'm misinterpreting, Mitch, let me know. He says New Orleans too is a good place to invest in for that asset class, but insurance costs has increased has increased substantially. Is that correct or no?
Yeah. I mean, the problem is New Orleans, the problem I have is not really, I have a problem with the construction of the homes. I don't really
Mm,
like older homes like that,
okay.
especially foundation.
Yeah.
I'll just tell you straight up, I'm not a fan of pier and beam foundations, period. And it's
Really?
nah, if you go to any contractor and ask them about pier and beam, they love them. They make a lot of money because it's guaranteed shifting, guaranteed.
I agree. I agree with that. I agree with that.
So you're gonna get cracks. You're gonna get basically you're going to have foundation problems over time. I'm not a fan of it. You could do however you want to. I've
Hmm.
noticed that I like slab, and so
Hmm.
you don't find too many slab homes in New Orleans. It's older. You already know. You know the area. You know what I
Hmm.
mean? It's older
Hmm.
homes. Um, so I know it. You know what I mean? I know
Hmm.
been downtown, know
Hmm.
the area. It's just not where I'm trying to invest. You also have some crime rates that's been out there that's crazy. It rains all the time, so you have some additional flooding issues that you may have to be aware of, hurricane issues that you have to be aware of. So it's just additional things that contribute to me when I look for a rental property. I'm
Yeah.
looking for stability and no
Yeah.
headache. I just want the cash flow to come in, take care of the tenant, and let them do what they do, live their life, and let me live my life, and not too many issues
Yeah.
or overhead to deal with.
Yeah. I agree. New Orleans is not a slab market. It's not as yeah. I can agree with that because of the financial going to shift. It's the same thing in Texas. Texas shifts a lot as well, also, but it's not as susceptible to. It's more welcoming to a slab foundation versus New Orleans. That's for sure. And I think New Orleans, most of New Orleans is in a flood zone. Am I right?
It's not considered a flood zone, but New Orleans basically is a flood zone. You know what I
Yeah,
mean?
yeah. That's what I mean. Yeah,
Yeah, yeah, yeah.
gotcha.
So it's like, and the number one problem I have is water. I had a bad flip one time, and it killed me because of the water. It cost me a lot of money,
Hmm.
and so I'm sensitive to that situation. So I ain't trying to deal with it, man. But hey, if it
I
works
got
out
you.
for you, do what you do.
I got you. And that makes sense, man. I mean, y'all got some game today, guys. And also, and we'll do probably a real estate live on this topic, guys. Seller financing, and this is my prediction. Okay, seller financing, guys. To me, it's going to be one of the most popular investment strategies moving forward because people are going to go from because remember I said when it came to leasing, right? If we're going to a renter nation, it's going to flip from 60-40, 60% home ownership, 40% rental. It's going to flip over to where 60% rental and 40% home ownership. I believe, guys, because of that flip, there's going to be a lot of lease purchase scenarios to where you can offer the leasee an option to own and you be their bank, or they have the option to go to an external bank, right? Just to pay you off. But you give them options. And I believe a lot of the leases are going to pick the seller finance option because they won't be able to qualify for that bank financing because the DTI is going to be too high. That's going to be extremely popular. Watch, mommy. You're going to see people actually paying in debt service interest payments to their debt service at maybe 3, 4, 5%, but then they're collecting 8% interest rates. So they're making a 3% delta there. Easy, anywhere from I said 3 to 5% delta. Give you an example. I did this back in 2009, 10, guys, and my rate was 2.5%, and I was collecting 10%
Mm.
interest. I was making more money than the bank was. I was getting calls from banks to buy my notes because I was making more than they were making. All right, man. Mister, what's making New Orleans attractive for me is that the seller financing is being offered a lot there, more so than other markets. Yes, sir. I told y'all, baby, it's coming. It's coming, y'all. Oh, man. Do you know what I think would actually revitalize a lot of these depressed areas when it comes to Baltimore, Detroit, Memphis, other places as well? Is this here, seller financing, because it gives people home ownership. It gives them home ownership. You can structure a deal to where you do a lease purchase and credit a portion of the lease payment toward the down payment, right? That makes some sense. And then you can negotiate a good interest rate for them to pay. And the thing about it is you're the bank for 30 plus for 30 years. You could do a 30-year amortized, 5-year balloon, 10-year balloon, 15-year balloon, however you want to structure it, 40-year amortized. To where if you actually acquire these property and you acquire 4, 5, 6, 7, 8, 9, 10 over the next 10 years, do the math. You're killing the game. And you've left a legacy for your kids. For your kids. I mean, that's going to be powerful. Cliff, you agree, man? You disagree?
Yeah. I see this. To me, it's a great exit strategy. It's just something else you can offer.
Yeah.
Because I'm definitely thinking long term. I want to start collecting the portfolio and putting the system in place and allowing just the cash flow to consistently to come in and just start
Correct.
stacking. Just start
Correct.
stacking. And so that's why
Yeah.
I'm big on just doing the acquisitions and turning quickly.
Correct.
I'm doing some, like I said, I'm looking in Detroit doing things, and I'm looking to
Yeah.
partner and do some other things as well. So
Yes.
overall, everything grows.
Yeah. My goal is to be too big to fail. A friend of mine actually, he's a very astute real estate investor, very astute. He actually began investing in real estate through seller finance. He'll acquire properties. He'll acquire them low, Cliff, in South Dallas. He'll acquire them low for like 5, 10 grand. Burn houses. The worse, the better. And he would invest the capital to get them fixed up. Then he would go to his bank and to refinance and pull their cash back out and make money tax free. And then seller finance it out. And he rinse and repeat it. This guy's portfolio is around about $60 to $75 million with one
Wow.
bank.
With
One
one
bank.
bank.
One bank. That bank it's a very big regional bank because they actually buy banks. They've been buying a lot of banks. He got so big that this is what the CEO of the bank told me. If this individual's portfolio began to go bad, they would not foreclose on him. They would invite him in to restructure a deal with him because he's so big.
Yeah. I
I
mean,
said, God damn.
so when you say too big to fail, what I hear is too painful to foreclose on.
There you go. Yes, sir.
It's
Yes,
like, do
sir.
y'all really want to go after 67 million, go through legal and all
Yep.
that, or do you want to talk to him and maybe give him a 2% discount on the interest
Come
so
on.
he can cash flow?
Come on, baby. And not only that, say, you know
Yeah, I
what?
see what you're saying.
We'll just remodify your loan down to 2% down. And matter of fact, we give you a little cash as well, also for you to be able to, get things right. No problem with it all. That's what happens with this gentleman.
Yeah, you're basically a manager for the bank. The bank is like, hey, we'll
Exactly.
allow you to make money managing the portfolio for us because
Yes.
you're way better at
They literally called him a shadow bank. They
it.
called him a shadow bank for them. It was crazy. I just
Yeah.
said, that was the first time I heard it. I just said, golly. That's crazy, Cliff. But yeah, that's for real. That's my goal for me.
Mm.
But not just at one bank, at several banks in several different cities, several different states. To be to fail. Yes.
Mm.
That is the goal.
Yeah, that's
And
what you're saying.
but yeah, man. But man, guys, man, this was a good real estate live, guys, man. Hope you learned something, guys. We do have a sponsor, guys. American Rounds, full disclosure, I own this company as well also. I invested capital in this company. It's the first AI-powered ammo vending machine in your grocery store, guys. We are exploding, guys. Hey, they're sponsoring this thing, so let's go and hear about them. Here we go. Let's get it again.
the CEO of American Rounds. We are in Pell City, Alabama at Fresh Value grocery store installing the first ever automated retail machine for ammunition. The stores were really the inspiration for it. I mean, they knew their customer base and they came to us and thought this would be a really good opportunity for their customer base. There's a lot of hunting community here in Pell City and thought that their customers would love an opportunity to be able to buy ammunition here at the store.
We're super excited to offer, what we think is the first ammo kiosk. We're always looking for ways to give our customer another reason to come visit our stores. Anything that we can do to help them make their shopping trips easier based on the feedback that we've gotten just from customers today. They are so excited about us having the ammo kiosk.
We're getting ammo!
One of the ways we're changing the landscape of ammunition sales is to make it more available. Being able to move into a place like a grocery store, supermarket makes it a lot more available to the public. But we're taking a different approach to it. Traditionally, ammunition is sold at outdoor type stores, your sporting goods stores, and it just sits on a shelf. It's very accessible. Because of that, there's a high rate of theft. But with our machines, as you can see here, we have a very secure automated retail machine. We're able to age verify. We scan a driver's license. It then takes 360 facial recognition for the purchase and matches it to the ID. So the machines really provide an opportunity for safe, affordable, and available ammunition sales.
There is no doubt that foot traffic will increase based on the feedback that we've gotten. And again, we're super excited not only to have it here, but in other locations in Fresh Value as well.
We're really excited about where we're going. We are going to continue to expand here in Alabama. We have a machine slated to go into Oklahoma, Louisiana, Texas. So over the next year, we're looking forward to, seeing these roll out all throughout the South and the Southeast.
Cliff, man, that is American Rounds, guys. That company is just exploding like crazy. I mean, it is. I think this is a Microsoft type of deal, Cliff. It is. We anticipate 300 reservations for machines this month.
Oh, wow.
300. And we anticipate being in the next 36 months, 1,800 stores. And and we got requests from, of course, we're in Alabama, Oklahoma. We have requests in Louisiana, Mississippi, Texas, Michigan, Washington State, Tennessee. We've even gotten requests for us to franchise it out. It's just exploded. It's just the first AI powered ammo unattended retail vending machine in grocery stores, and it's crazy.
No competition.
We're the first to market.
Right. Yeah.
We're the first to market. So this has attracted a lot of interest from VCs, private equity companies. After my company invested into it, it is just, man, it is, Cliff. When I tell you, man, this is huge. I believe in the next 60 months. I believe that we get offered to. We're currently getting offers to potentially getting bought out next year. Now.
Oh, wow. That's crazy.
Dick's Sporting Goods, I believe, is no longer selling ammo on the shelves. You have Cabela's and you have Bass Pro Shops. They are beginning to look at ways to not offer ammo on counters, or so to speak, on shelves because of theft as well also. And there's a lot of manpower that has to go into restocking that. And the bulk of their sales is in, of course, firearms themselves. And this is a more secured, safer way for consumers to be able to acquire the ammo on demand. I mean, you could acquire ammo in 30 seconds. It's that quick.
That's crazy, man. No, it's a good platform, man. It makes sense.
But yeah, man. But guys, man, this was a long one, Cliff, man. We gave them the bag today a little bit, dog, man. I hope you guys took some notes. You gave y'all a whole bunch today. Am I right, Cliff?
Oh yeah, man. We coming back from vacation, man. I felt like, going a little bit long for y'all, so it's all good.
But guys, you know how it is, man. You know how we end it every time, guys. Before you leave, and while you can, you see that thing, baby. Take that damn picture and give it to your mama and them, and holler at your partners, guys. See you guys next week, guys. All right, y'all. Peace.
Give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big